Welcome, everybody. It's a pleasure to and an honor to have this opportunity to talk to you about my view of where we are and where we need to be. Today's agenda for this preparing for market volatility is this first slide here. We're going to talk a little bit about diversification, how our alternative investments did in the recent sell-off. We're going to take a long-term view of markets and study how market timing may or may not work for long-term performance. I'm going to talk quite a bit about our closed-end fund strategy and how they can interact with distressed markets, and then I'll make some concluding remarks, and hopefully I'll have some questions to answer, some nice easy questions to answer. But the topic of this is how to deal with market volatility, and I hope a number of you had the opportunity to listen to me live or through the files that we can send you of the presentation that I gave just a few months ago on preparing for market volatility. And when I entitled it Preparing for Market Volatility, I certainly didn't know that within 2 months we would have such substantial market volatility. And but you're going to see that there's going to be a little overlap between this presentation about dealing with market volatility and the presentation that I made a few months ago about preparing for market volatility. But because to be clear about this, I don't think that much has changed. Yes, we're a little bit financially poorer because of the decline, but the investment philosophy that I have really is independent of these sorts of market events. So let's move to kind of a big picture of where we are. This slide just is a picture trying to illustrate what the kind of the old school or the traditional school of portfolio management is, somewhat narrow, and that is that we hold 3 buckets. The bucket on the left is our stocks or equities, and it's simply whether it's individual stocks or it's mutual funds. These are long-only positions, meaning that you just buy these stocks. You may exchange them, but it's kind of straightforward strategies of buying stocks, buying bonds, and putting money into cash. And it tends to, for Americans, it tends to be very U.S. focused in the traditional model. And we at Biltmore adopt a strategy that's shown on this next slide, which is, yes, we invest in equities with probably more of an emphasis on international stocks in the more modern portfolios, not just at Biltmore, but in the more modern wealth management. We're getting diversification by tending to have more funds outside of the U.S., even though I have been and continue to be rather bullish about U.S. markets. I spoke a couple months ago. Those of you, again, that heard that presentation, I said at the time that I thought the U.S. markets were certainly not cheap. I thought they were a little bit overvalued. And I think that now with the correction, I consider them to be more appropriately valued. But then again, I see international markets down as well a little bit. We would invest in bonds very much like the traditional models would suggest. But the biggest difference is this use of alternative assets. And we at Biltmore define alternative investments or alternative assets rather broadly. We put some things in there that some people do and some people don't include, such as real estate investment trusts and MLPs, master limited partnerships involved in the energy sector. We include those in the alternatives buckets just because they are allocations that a lot of traditional investors don't include, so that's why we think of them alternatives. But most of our alternative investments are unambiguously alternative investments. And I want to talk about those in a minute. I wanted to move next to my overall thought about long-term investment success. I've been at this, I got my PhD 34 years ago in finance, and I've been practicing it ever since. And it took me quite a while, maybe 10 or 15 years, before I really developed this 3-pronged approach that I have listed here. And I want to clarify these 3 factors that I think come to play. The first one on the left is historical evidence. We've all heard the admonition that past performance does not necessarily predict future performance. but we learn from viewing the past. But evidence is that we don't learn very well by looking at the past. We have this human nature of wanting to seeing what we want to see, kind of ignoring some things and overemphasizing others. So when I talk about looking at historical evidence, it really is one of the major ways that we understand whether we should be in stocks or bonds, if we should be in stocks, how should we be in stocks, which stocks should we buy. That should, largely speaking, be based upon historical evidence, but we have to do historical evidence very clinically and very carefully to avoid fooling ourselves into believing that we can do things that we actually can't do, such as come up with some amazing strategies such that we can always be out of the market when it heads downward. If you go over to the right side of this, in addition to historical, well-founded historical long-term analysis, I also believe in really solid economic reasoning. If we're going to put the majority of our money in stocks, which reasonably wealthy long-term investors should have the majority of their money in stocks, why would we think that they should be in stocks? Does that make economic sense? What is the rationale and theory as to why people in markets lead us to the conclusion that we should put so much of our money in equities? It certainly was not the way economies were 120 years ago. Why is it that way today? So economic reasoning is a really important part of the decision-making process that I utilize, that we utilize at Biltmore as well. And then there's this box in the middle, which is emotions. And I certainly care tremendously about our clients and my own personal wealth. And it's very tough when markets are going wild and the market is way up, and because we hold such well-diversified portfolios, our portfolios tend not to be up as much as an individual sector. If the US stock market's going nuts, going up so rapidly, we will not tend to keep up with it because we're better diversified than that. And of course, when there's an economic downturn, a correction like we've had in the past week or two, it's devastating across the board, and these things really get to us emotionally. And I have learned in my quite long experience of 35 years to try to keep my emotions out of it. And as I say, it's difficult when you care a lot, but you just have to be that way. It's somewhat like a surgeon might be. We have to put the emotions aside and do what we know is right. And so that's one thing I've learned, is that markets tend to vacillate between greed and fear. And if you let fear or greed get to you, then you tend to sell off at exactly the wrong time, and you tend to get in at exactly the wrong time. So we really try to get emotions out of this and keep a steady strategy regardless of current conditions. This slide that I'm showing here, it plots the S&P 500, the US stock market, over the last 10 or so years, and it's not really completely up to date. If you look to the very far right here, it's showing the market down maybe 7%, and of course if we look at it today, I think a good ballpark figure for where we are, first of all, for most of this year we've been level, and since certainly March of this year we've been pretty level, and now we're down about 10% as of right now as I speak, and a couple days ago we were down 10%. A rough figure of where we are is that the US equity market, the US stock market, is down about 10%. And if we look at this over the past 10 years, and we're going to take a longer term view later, we'll see that when we hit the 10% level, a lot of people refer to a 10% or more decline in a market as a correction. 20% they might refer to it as a bear. Those are very rough numbers and very rough terms. But we're certainly, I think, in the area of a market correction now. And it's the sort of market correction that we saw back in 2011. We certainly saw it in 2007. It's the sort of things that you're going to see a couple times a decade. It's certainly not a major bear market that we're in, but I don't know how this is going to turn out. This could be some tremors that we get into September and October, and they turn into a true bear market in a financial crisis. It certainly could happen. I don't know if it'll happen. I don't think it'll happen, but it could happen, and we need to be prepared. If we look back at 2007, we see these sorts of tremors where in the we lost some money at the end of 2007 and then in mid-2008, and those weren't buying opportunities, of course, because what happened then in fall of 2008 is a very, very substantial, once every 50 years sort of market decline. So that's where we stand. It's tough. But it's the sort of thing we should expect every 5 to 10 years. Certainly more than that, a couple times, maybe 2 or 3 times a decade. The next slide shows, and the first line here, this is where the S&P 500 was over the particular interval that's listed in this slide, which is August 17th to August 25th. I didn't cherry pick that. That's just kind of the high going into this correction and where it was when I made this slide a few days ago. I used an end of day figure. And the first slide, the first row here shows that the S&P 500 as measured by the big ETF that follows that, ticker symbol SPY, was down over 7%. And then what's shown in the panel underneath that are the 7 major alternatives that we have in what we call our moderate portfolio, not for the most aggressive investors, not for the most conservative investors, but rather for our more middle investors. And we do have the sort of mixed results that we would find. That's why we hold multiple categories, so that we don't concentrate in one category, and we diversify across 7 categories. 2 of these categories were up. Managed futures was up substantially. Market neutral was up a little, about what we should expect. And then we see that 2 of them were down quite a bit. Those are the ones that are least alternative, the REITs and the MLPs, the Master Limited Partnerships. But altogether, they were down 2.3%, which is about 30% as much as the market fell. And that's what we're looking for. We're looking for something that, yes, it's going to have some what we call directional exposure. It has exposure to whether the U.S. equity market goes up or down. It also has exposure to whether the bond market goes up or down. But it's not as exposed as having your money in stocks or bonds. As I talked about quite a bit in my previous presentation about preparing for market volatility, equities were quite high priced, and they're still, I think, they're certainly not cheap. Bonds, interest rates are historically low. It's just devastating bond returns. Even if interest rates don't go up, you're barely going to keep up with inflation. And cash, of course, where you're earning almost no yield now, is devastating. So it's a difficult time to be in the financial markets, and we think that an exposure of 20 to 30% in alternatives, broadly defined alternatives, is a very reasonable thing to do with interest rates this low and with equity market valuations still moderate to moderately high. So we're reasonably pleased with how the alts performed. They performed as we would expect. We would hope, of course, that they always would do better, but they performed as expected. And I'm convinced that if we had a devastating financial market in the rest of September or into October, some of these sectors would hurt. Some of them temporarily would hurt, but you will be better protected in these alts than if you were directly exposed to the equity markets. The next slide goes back to looking at the U.S. equity market. And what I like about this slide is it takes these 4 bear markets and makes a bigger picture at the bottom, so we can see in the context of this 40 years how what we're going through right now matches up against the past. If we go back into the 70s, and I certainly remember the 70s, it was not only that the U.S. equity market was down perhaps 40%, long-term bonds were down 40% as well. It was just a devastating time back in the early to mid-1970s. That was an incredibly tough market, especially because of the bonds, but equities were down 40%. If we think of in 1987, there was just this very quick crash. It was actually over a period of 4 days, down in much more volatile than it was the past week or two. It lost 4% each day roughly for 3 days and then fell another 20-some% for a total drop of 33% in 4 days. So this has been a pleasant week compared to October of 1987. That was a quick market, but it was down a third. Of course, I'm sure we all remember the recession of 2002, 2001, 2002, and the market being down perhaps 60% then, and the most recent financial crisis where it was down 50%. So we'll come to another slide that shows these numbers. I'm not trying to inundate you with the numbers, but the idea is that there's been a lot of major markets downs, and so far we've been down rather modestly compared to those markets. This is another slide which shows declines going all the way back to the Great Depression. The bar on the top shows the orangish red to the left shows that the stock market there lost 83%, by some measures 90% of its value over a 3-year period, but then it came back remarkably over the next 13 years. And it goes through the major declines that you see. And I draw your attention to the second column here, the loss column. And what you see is that losses of 20%, even 30%, they do happen occasionally. Drops of 50% happen, they even 80%. And right now we're at about a 10% loss. What this slide tries to illustrate is the idea that the blue line, the light blue line here, is what happened in the financial crisis for the stock market. And you see it down 50% here. If you let fear take over, the investors, and there are quite a few of them who let fear take over and bailed out of the stock market when it was down 50%, and things looked so dismal back then. I think we all remember it vividly. If you got out and just said, I'm going to put my money on the sidelines for 1 year, you would have missed out on a portion of the bull market. But by missing out on that portion of the bull market, when you include compounding, you'd find yourself down 30 or 40% from if you stayed in the market. So we want to be very careful about trying to time in and out of the market based upon my forecasts or anybody else's forecasts of whether the stock market is going to go up or down. That market timing to me is a speculation that should only be done in very small adjustments. So perhaps a small adjustment to equities can be appropriate, but large scale moving in and out of markets is not appropriate unless something substantially changes with regard to your circumstances. If a person loses their job, maybe that's a reason to make a major change. I talked about, this is actually the same slide that I showed 2 or 3 months ago. I believe it's identical to this, the 3 ways of coping with portfolio risk. Number 1 is to diversify to reduce concentrated positions in individual assets. And that's something that Biltmore does extremely well. When we talk about when you look at your financial reports and you see that we're maybe in 20 different funds, it's important to realize that underneath those funds, some of them are hundreds of individual securities, so that underneath your entire portfolio, we probably have thousands of securities. And if an individual stock, just let's say there was a lawsuit and a particular company like Pfizer blew up, if it didn't affect the rest of the stock market, you might not even notice it in your portfolio. It would be such a small effect, even though Pfizer's a large firm. That's how well diversified we are. We've got thousands of underlying assets. We're also diversified not just within the stock market, for instance, but across the equity markets and bond markets, and domestic versus international. So we want our portfolio allocations to be well diversified. But of course, in a broad market downturn, when all the individual assets go down and when the US markets go down and the international markets go down, it's painful. And the question arises as to how do we cope with that? And as I talked about several months ago, and as I'll spend some time on remaining here, we have a strategy for that. It's this closed-end fund strategy. So I want to move to that with a little bit of background here. We all hear the concepts of mutual funds. And there are actually different types of mutual funds, but the main mutual fund that most people talk about, if you were to put your money into Fidelity or a Schwab mutual fund or a Vanguard mutual fund, most of those, that when we talk about those, what we're talking about is a regular mutual fund or an open-end mutual fund. You actually buy it, even if it's through a broker, the money actually goes directly to the mutual fund company like Fidelity, and they put it in their Fidelity mutual fund. And it's done on a daily basis. You buy it at 4 o'clock at night, 4 o'clock in the afternoon, and someday if you sell it, it's going to be sold at 4 o'clock in the afternoon. And that trade does not take place on a stock exchange. That trade just takes place directly with the company. So Fidelity cashes you in with the day you want to get in, and they cash you out with the day that you want to get out. Now the key thing is, what price do you buy that mutual fund and what price do you sell that mutual fund? And the answer is, unless there's sales charges, the answer is at the net asset value. So what this slide talks about with this example in the middle is that with this Acme All-Star mutual fund, if it holds $1 billion in stocks or bonds or both, and there's 50 million shares that have been issued against those, then the net asset value of each share is $20. So $20 is really what the value of each share in that mutual fund is. And if you buy it, Fidelity will sell you the shares at $20 a share. And then a month later, let's say that stocks haven't gone up or down, it's still at $20 a share, then you can sell it at $20 a share. And this is what we do. Many of our holdings are open-end mutual funds. We buy them at net asset values. We sell them at net asset values. And whether you make money or lose money depends upon whether the portfolio underlying that mutual fund has gone up or down. So that's what most people think of when they think of mutual funds, and appropriately so, because that's what most people invest in. But what we're investing in a little bit in these financial markets, and in which we're prepared to invest very substantially in if markets get really, really distressed, is closed-end mutual funds. And the reason is well illustrated by this slide, which I also showed a couple months ago, if those of you that were heard that presentation may remember it. This is a stock, it's actually, this is a closed-end mutual fund that holds Pennsylvania municipal bonds in it. I'm a Pennsylvania resident, and I've been trading this closed-end fund for quite a while. And what this graph shows is that the market price of this closed-end fund trades differently from its net asset value. And the small sections of this diagram where it's above the major horizontal line here is when it's actually selling at a premium. Now, what do I mean by that? These closed-end funds do not get bought and sold through a company like Fidelity. They get bought and sold on the stock exchange, the New York Stock Exchange. And the price that it trades at could be very different from its net asset value. And this diagram shows how different these prices are from their net asset value. And when it's above the line, it's showing that you're actually, if you're buying it, you're paying more than the net asset value to get into this mutual fund. I don't know why anybody would do that. And when they're below it, then you're buying the mutual fund at a discount from its net asset value. So for instance, we will hold an open-end mutual fund. We're holding it at net asset value. And our strategy is that when these closed-end funds become substantially discounted, and that's not easy to, it's not as easy as it may sound to know exactly when that is, but when they appear at a large discount, we buy them, and when they go to a smaller discount, we wouldn't even wait till they reach a premium. When they go to a small discount, we would sell them. Now, sometimes individual closed-end funds do this all by themselves. All of a sudden, a closed-end fund will go to a large discount. And usually a reason will be something like it cut its dividend. And that's a great time to buy it, is when they cut their dividend. Because anything that they don't pay you as a dividend, they reinvest inside the fund. So you're really getting a free lunch there. So it could be that a particular fund drops. It could be that the sector explodes to large discounts. Right now, the discounts in municipal closed-end funds are quite attractive. By historic standards, they're in the area right now of 14 or 15%. That's pretty attractive. But sometimes in a real bad financial crisis, they go to 20, 25%. And that's the time that we want to go from making the small investments that we've been making in closed-end funds to making large investments in closed-end funds. And we can do this in almost every sector of every one of our portfolios. We can do it in municipals, municipal bonds. We can do it in regular corporate bonds, high yield bonds, investment grade bonds. We can do it in US stocks. We can do it in international stocks. We can even do it in alternatives. So for instance, our merger arbitrage fund is available in both the closed-end format and an open-end format. And if the markets get volatile enough and fear-ridden enough, it may come a time, I expect there will come a time, hopefully not in the too near future, but where markets get so distressed that we can switch from the open-end product to the closed-end product and get it at maybe a 20% discount or a 25% discount. And then when markets return, we switch back from that closed-end format and the discounts converge back towards zero. We switch back from the closed-end form to the open-end form. Now, I don't want to say that I'm looking forward to distressed financial markets because they are not fun. 2008 was not fun. I remember it vividly, as I'm sure many of you do. But if a crisis like that happens, there's going to be some great buying opportunities. I'm 100% convinced there will be some fantastic buying opportunities. We didn't make major movements in the past week into closed-end funds because the buying opportunities weren't that exceptional, and we didn't know if the market really had bottomed out. Once we see discounts up in the 20% area, that's, I think, I'm picking a very general number there. It really varies by the sectors. But when we start to see larger discounts than we're currently seeing, we might start to make some moves. So that is one way, other than just diversification, in which we can prepare for and cope with market volatility. So as I concluded my last presentation, the three things in life that you want to worry about in investments are diversification, diversification, and diversification. With that, I think the 30 minutes is up. I think I did that just about on time, and I would love to hear some questions or be able just to respond to comments, anything that's